Buffett once shared, "I will tell you how to get rich. Be fearful when others are greedy and be greedy when others are fearful." How to invest like Warren Buffett, one of the greatest investors in history. Warren Buffett is one of the greatest investors in history. He transformed Berkshire Hathaway from a struggling textile company into the trillion-dollar conglomerate it is today. Buffett's success is based on a set of basic principles that any investor can learn from, although not necessarily achieve the same results. 1. Remember that stocks are businesses. People often think of the stock market as a fast-paced environment where prices flash across screens and buying and selling decisions are made constantly. However, Buffett reminds investors that stocks actually represent ownership in businesses. A serious businessman does not buy a company and then sell it in a few minutes or weeks. In his 2022 letter to shareholders, Buffett wrote, "Please note that we own public stocks based on our expectations of their long-term performance, not as a quick sale vehicle." 2. Buy with a margin of safety. Buffett uses the intrinsic value method to evaluate businesses and stocks. He values a business based on the cash it will generate in the future. He then wants to buy at a price below its intrinsic value, creating a margin of safety. Buffett believes this is the most important thing in investing, protecting investors if their assumptions about the business are incorrect. 3. Ignore stock market predictions. There are many analysts and commentators who make predictions about the stock market. Buffett advises ignoring these predictions. In his 2013 shareholder letter, he wrote, "Thinking too macro or listening to someone else's macro predictions about the market is a waste of time. In fact, it's dangerous because it can cloud your view of what really matters." 4. Identify quality businesses with high returns on capital. Buffett's ideal business is one that generates high returns on invested capital. These businesses typically generate large cash flows for shareholders and are well positioned to sustain high earnings. Buffett often cites See's Candies as his ideal business because it has high returns on capital, pricing power, and requires little capital to grow. By 2015, Buffett said See's had generated $1.9 billion in pre-tax profits for Berkshire with just $40 million in additional capital. 5. Look for a competitive advantage. Once you have identified a business that has a high return on capital, you need to look for a competitive advantage that will allow you to sustain those profits. The nature of capitalism is that high profits will be attacked by competitors who also want high profits. Buffett calls these competitive advantages economic moats that protect the business's castle from threats. These advantages could include a strong brand like Coca-Cola or Apple, or a cost advantage like the Geico Auto Insurance Company. 6. Stay within your circle of competence. Buffett only invests in businesses that are within what he calls his circle of competence. This means that he must be able to understand the business and be confident about its future. For many years, Buffett avoided investing in technology because he felt it was outside his circle of competence. It's not that he doesn't understand these businesses, it's that he's not comfortable predicting where they'll be in 5 or 10 years. If you have any doubt about whether something is within your competence, it's not within your competence, Buffett said in 2002. 7. Focus on your best ideas. Diversification is often considered a cornerstone of investing, but Buffett has long believed that if you know how to value businesses, diversification is unnecessary. In fact, at the end of 2023, just 5 companies accounted for about 79% of Berkshire's portfolio. Buffett told shareholders in 1996, "We think diversification, as a general rule, makes little sense for people who know what they're doing. Diversification is a protection against ignorance." Buffett added that there's nothing wrong with not being good enough at analyzing a business. For these investors, he recommends holding a diversified index fund like one that tracks the S&P 500. 8. Take advantage of market recessions. Bear markets and market downturns are inevitable when it comes to investing, and Buffett has used them to his advantage over the years. Investors should strive to get the most for the least amount of money possible, and market downturns often offer attractive prices. During the 2008 financial crisis, Buffett took action, buying stakes in Goldman Sachs and other financial firms that were struggling. He also bought BNSF Railway in 2009, which has become a key asset for Berkshire Hathaway.